It was a tough day in the stock market with the S&P 500 closing lower, just under 1%. So the end result was not particularly terrible because Apple and Microsoft did pretty well. But in terms of the actual participation in today's market, it was pretty bearish. We had over 80% of the stocks closing in the red here today. Part of it is as a result of some of the ADP payroll information. The number came in very hot, given the market the impression that it's going to give firepower to Jerome Powell to continue raising interest rates if he so desires. We're going to take a look at interest rates in tonight's video, and they have been surging. In fact, the 10-year Treasury yield is now at its highest level since back in March, and one of the higher levels of the entire past year. So that had an impact on a number of different asset classes out there, including the utilities. You also found that the energy stocks suffered here today. So we'll talk about all of that, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a tech stock that has started to sputter here recently, is now trading back below its 30-day moving average and has a bearish near-term divergence. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 6th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. If you're not following me yet, I would encourage you to do so. Also, we appreciate those of you that click like and retweet on those Market Outlook related posts. We did also, by the way, join the Threads group, or I guess you would call it social media service, that is being presented as a Twitter alternative from Instagram. So you can also look us up using just our normal handle @MarketScholars over on Threads as well. I doubt we'll be posting there nearly as much as at Twitter, but nonetheless, for those of you that are going to check it out, make sure you give us a follow over there as well. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity, and let's get started here with our S&P 500 heat map. And you can see that it was quite the selling day, or a day that was dominated by bearish activity. It wasn't the worst we've ever seen, because when it was all said and done, we didn't even close lower by 1% in the S&P 500, and it's been quite astonishing to see the market's resilience in that regard. We have not had a 1% sell-off day in over a month. And remember, 1% sell-off days are not anything overly extraordinary. They are a very common occurrence. Yet in this very bullish year of 2023 that we've had so far, you've had very few of those. So today seemed like the type of day that would get us to a 1% sell-off, but it just wasn't in the cards. Earlier in the session it was, but we had a rally to end the day. So anyway, while it looks pretty ugly when you look at the red boxes versus the green ones in front of us, in the end, it was not a dramatic result with the finishing percentage. So let's get into it and see what we can learn here. Part of the reason the S&P 500 managed to not close lower by more than 1% is probably because the two largest companies in the S&P 500, which remember is a market cap weighted index, meaning that the bigger the stocks are within it, the more influential they are on the end result. Well, Apple is the largest publicly traded company on planet Earth right now at a $3 trillion market cap. Guess what? It was up today. It was up not by much, but by 0.25%. And then Microsoft is not all that far behind them these days at a $2.5 trillion market cap, and it was up nearly 1% today. So actually a pretty decent day there for Microsoft. So that is likely the reason that the end result was not worse. If you took Apple and Microsoft out of the mix, I'm sure we probably would have ended up with worse than a 1% sell-off today. So you can send your thank you notes to Seattle for Microsoft's case, and to Cupertino in Apple's case. In terms of the other big players out there, most of them did end up closing in the red today, including Alphabet, which was down over 1%. We had Amazon down slightly over 1%. We had Tesla down about 2%. We had Nvidia down 0.5%. And we had Meta that was down 0.8%. Now, Meta, of course, is front and center of what I had just mentioned here a moment ago during the intro about their new social media platform called Threads. And of course, they are trying to steal market share away from Twitter. A lot of people have been kind of fed up with the leadership at Twitter and all the changes and all that kind of stuff. And so Zuckerberg and company look at that as perhaps an opportunity to steal a little bit of market share. But while their launch has been reasonably successful and they've had millions of folks signing up, it didn't really help the stock at all today. Earlier in the session, Meta was actually higher, so it seemed like it was going to be a good thing for it. And they've had a very good week, so we got to be fair there as well. They obviously are in an immense uptrend at this point, like a lot of other tech stocks. But it was a little bit interesting that, with it launching within the last 24 hours or so, that you did have a little bit of a disappointing end result with Meta down by 0.8% here today, after it looked like we were going to have a somewhat enthusiastic response earlier in the session. In terms of other bigger players, JP Morgan was down about 1% today. By the way, this is somewhat rare, but speaking of social media, I had just noticed that my JP Morgan tweet about Jamie Dimon now has 1,218 likes. So when we ask you to like our market outlook video and it seems like quite the chore to get to 100, remember that we have proof here that we can get way beyond 100 every so often. This is actually just the second time that I've ever gotten over 1,000 likes on a tweet. I think David's done it once as well. So every so often you kind of hit the you hit the algorithm just right, and your message gets sent out to a lot more folks. So thanks to all who supported that particular tweet. You might not like his message, but I would encourage you to listen to Jamie Dimon's rant here. If you are offended by American exceptionalism, perhaps you can skip it. Otherwise, if you want a note of optimism about this country of ours, then perhaps that will be a message that you appreciate. Might not always appreciate the man himself, and he is a flawed man just like all of us, but I do appreciate a little bit of optimism here and there. So anyway, JP Morgan was also down here today, about 1%. Bank of America was down nearly 3%. Now, what's somewhat interesting about Bank of America is just yesterday they announced their dividend increase. Remember, most of the other big banks came out with their dividend increase plans late last week after those CCAR results and after those stress tests and everything like that. And from my perspective as a dividend investor, the dividend increases have actually been impressive. I figured this would be a year where the banks would kind of use the regional banking crisis as kind of an excuse to kind of lowball the dividend increase in this calendar year. But boy, they've kind of impressed me. We're looking at high single digits, low double digits in most of the cases. So Bank of America, I think theirs was 9% they came out with yesterday, so they were a little bit delayed by a few days. But it didn't really impress the market today. They were still down 3% here, as was Citigroup. It was down just over 3% in this case. PayPal, of course, has had a very tough go of things in the last couple of years. It was down nearly 4% today. They're one of the rare financials that does not pay a dividend, as they're still considered more of a growth stock. Morgan Stanley pays a dividend. They were down over 3% today. Goldman was down over 2%. American Express was down over 2%. So, the financials didn't really seem to be a great place to be hiding today. You had a few of the insurance companies that managed to skirt by with gains, including Chubb and Progressive. But otherwise, it was kind of few and far between in that regard. It seems like some of the other areas that really took it across the chin today were consumer discretionary and energy. If you kind of look at those two areas, with consumer discretionary up here and then energy kind of a little bit below it down here, notice that the shading of those red colors is a little bit brighter than what you see with some of the other sectors, meaning that the sell-offs were a little bit more aggressive. And so, Amazon, Tesla, Home Depot, those are your big three within the discretionary area, and they were all down fairly considerably, right? Somewhere between 1 and 3%. Down in the energy patch, Exxon was down nearly 4% today. Conoco was down 3.5%. Remember, I think we still have an iron condor going on Conoco, and that actually benefited us. That move today, it helped kind of neutralize where our strikes were. But the energy patch didn't seem to be the best place to be hanging out today. We actually concentrated on the energy patch in my my dividend growth investing class today. Today was actually the first day of the second semester portfolio. So for those of you that aren't familiar with that particular class, we will go forward for the next 25 weeks buying one dividend growth stock per week, and we usually do a head-to-head matchup of two companies that would fit our class rules and kind of compare them side by side to see what choice would be better for the class itself. So if you are a premium member or a plus member of Market Scholars, feel free to check out that recording as well as we kick things off. And today we also had the conversation about our stink bids. Had a nice trip down memory lane back to August of 2015 when we had the mini flash crash day, and 5 of the stocks that we got filled upon on that day. So the first class of each semester, we like to put in our stink bids just in the off chance we have some sort of a chaotic market event that occurs, and we have our orders placed and ready to take advantage of any sort of chaos that may take place out there. So anyway, energy to the downside here today as well. Looks like utilities struggled there as well. It seems like nearly all of these stocks, as far as I can tell, yeah, it looks like all of the utility stocks were in the red here today. So not a good performance there. I think interest rates were going a bit higher here recently, so that interest rate sensitivity that the utilities typically have probably didn't help their cause here today. In terms of other green or positive performers today, there's really not much in the way of actual patterns that I see out there. I would mention that automatic data processing, Paychex, and Paycom all were up today, and I don't think that is a coincidence. I think they were up because we did hear the ADP payroll numbers here today, and the employment situation is still very strong. It's part of the reason why the market sold off today, is the fear that Jerome Powell will use that as an excuse to continue raising interest rates. But for those that participate directly in payroll processing, that's a good thing, because they make money off of volume, and there are certainly a lot of people employed right now. Pretty much anybody who wants to be employed in the United States is. So that's a good moment in time for those types of companies right there. All right, let's go ahead and now take a look at the more specific numbers on the main part of the platform. Coming on over here to the Market Watch tab, I've got the S&P 500 pulled up, and as you can see, there were 84 advancers in the S&P 500 today, with 416 decliners. And so on a percentage basis, that's about 16% of the market was higher today, and 84% of the market was lower. So it wasn't the most extreme day that we've ever seen, but it was amongst them, right? Anytime you have kind of a 20-80 split or worse, it's a pretty extreme day. So without a doubt, while today was not a terrible end result percentage-wise, courtesy of Apple and Microsoft, it was a bad day under the surface from a breadth perspective. So that puts kind of the ribbon on the actual numbers of what we saw a moment ago with all those red squares and rectangles on the heat map. Coming on over here to the charts now, I was going to show you this real quick as well. I already mentioned it, but just to confirm it with your own eye. If I pull up chart 6D here, you'll see that the S&P 500 was down 0.79% today. And notice how this red bar did not come and close below the blue horizontal line. Again, earlier in the session it would have been there, but in the last hour or two you had a rally into the close. So you didn't have as nasty of a sell-off as you might have been expecting. And the last time we had a red bar that officially closed below that blue horizontal line was back here on May 23rd. So that's over a month ago. You can't get a measly 1% sell-off in the S&P 500. That is how robust this market rally has been in the last several months here. So anyway, today seemed like the day that maybe I could just get away away with selling some puts again, because most of you know that when we do have those 1% sell-off days, I like setting up those sold put trades. And the ones that I have done in the past have worked out fairly nicely. We still have a few of them on our books right now. The problem is they've been few and far between. I'd like to do more of those types of trades, but we just haven't been in the market environment where I've felt as comfortable doing it. The other thing that I would mention is that the VIX did rise fairly nicely today. This purple line down below here will represent the pathway of the VIX. It ended at just above 15 here today, but it was down here at about 13 yesterday. So that was actually a pretty healthy move to the upside. I think it kind of pulled back a little bit at the end of the day when the market was rallying. If we want to look at the actual candle here, you can kind of confirm that with your own eyes right here. Maybe I could zoom in a little bit there as well. Doesn't really help that much, but you can kind of see what I mean. This long upper shadow here on the VIX suggests that it had sold off into the close while the market itself rallied into the close. Remember, the market and the VIX are effectively inversely correlated more times than not. And so at one point during the session, the VIX got as high as 1708. It ended up closing at 1544, so a pretty healthy give back there. Nonetheless, it was a decent sized move off of where we were just a couple of days ago. So we'll keep our eye on it, but obviously when we're talking about the VIX below 20, this is not a market that is particularly fearful right now, despite what was a pretty solid rally in the fear index here today. All right, let's go back on over here now to our typical routine with our 4 grid. This is chart 4B for those of you that are premium members following along at home with your own charting package. You can see that despite the sell-off here today, all of our charts remain with a strongly bullish posture. That actually surprised me a little bit. I figured today was an aggressive enough sell-off day where maybe one or two of the indices would have given back their postures and gone to weekly bearish, but we didn't quite get there. The one where it's the closest is probably the Russell 2000. Notice down below the Russell 2000's intermediate line is at 82.14 and falling. You can read that in the green label right there. Notice up above it, the Dow Jones has an intermediate line at 82.18 and rising. So that's what kind of differentiates the two. They're both nearly identical in their number, but one of them is rising. You can barely make it out, but it is rising just a touch. Whereas the green line on the market, or on the Russell 2000, is kind of rolling over a little bit there. So, based upon that, knowing nothing else beyond that, you would assume that if one of these goes to a weekly bearish posture, it'd likely be the Russell 2000 that does it first. Obviously, no guarantees there, but if tomorrow's a sell-off day, there's a decent chance that Russell 2000 will go into the weekend with a bearish posture. And you could actually see that on the Dow as well. With the S&P 500 and the NASDAQ composite, I'd be personally a bit surprised if we went into the weekend with a bearish posture. But anything's possible, right? If we have a 3 or 4% sell-off day for some strange reason tomorrow. And tomorrow, by the way, is going to be an important day. Tomorrow is the jobs number. Remember, the first Friday of every month is typically when the jobs number gets released, and that's before the market opens. And so there is a possibility of having a little bit more volatility before the opening bell tomorrow. So keep your eye on that possibility there as well. But assuming there's not absolute carnage in the market tomorrow, I would assume that the S&P 500 and the NASDAQ will go into the weekend retaining their currently strongly bullish posture, whereas the Dow and the Russell 2000, I'm a little bit more concerned about those. I could see those two transitioning back to the bearish postures. Notice that the Russell 2000, by the way, just barely hung on to being above that rising 30-day moving average. Earlier in the session, it had cut below it, but with that rally at the end of the day, it was enough to just barely close the index just slightly above that rising 30-day moving average. So even a sell-off of, let's say, 0.2% tomorrow, you could see that moving average color will change to a yellow color tomorrow, and then you would likely see that the background of the chart would probably turn to this lighter pink. So that's what I'm going to be on the lookout for tomorrow. Obviously, if the jobs number is what the market wants to see and we get a big rally, then all bets are off. But if there's any sort of a sell-off tomorrow, I'm going to assume that the Russell 2000 goes into the weekend with a weekly bearish posture and a yellow 30-day moving average. In terms of the actual numbers here, that we saw today, the S&P 500 was down 0.79%, the Dow Jones was down 1.07%, the NASDAQ composite was down 0.82%, and the Russell 2000 was the worst performer, down 1.64%. So the S&P 500 fared the best, and the Russell 2000 fared the worst. In terms of any potential bullish intermediate confirmation signals, we didn't actually end up with any today. It looked earlier in the session like we probably would have. Remember, what we need to see on that is for the green line to be considered bullish, and right now with all four of these charts, green lines in the upper reversal zone, they would all be considered bullish. So that part, no problem. But the second part of the bullish intermediate confirmation signal is the red line would have to be in the lower reversal zone on that same day. And earlier in the session, that was the case with some of these, but we didn't actually end below 20 on that red momentum line on any of these four charts. Notice the closest one was the Dow Jones Industrial Average. The red momentum line ended at 2167, and you can see, without that label, you would have really had to squint right there to see whether it was below that black horizontal line or not on the chart. Of course, you guys can always go in here and right-click and maximize the cell to see it a little bit better. So maybe if you've got some good eyesight, you can see that red line is just barely above the black line down there. But for those of you that are starting to have worse eyesight as the years go along, I include myself as part of you, then that label that we have there on the chart will be particularly helpful for that type of a situation. So had that red line closed just a couple of points below where it did, it would have been a bullish intermediate confirmation signal today. And the blue line is actually between 20 and 50 where we like to see it as well. And this chart is still above a rising moving average. So in a way, that kind of would have been a nice signal there, where what you're trying to do with that signal is buy the dip of a continued uptrend, right? The green line is telling you that the intermediate trend is still bullish. The red line is telling you that the short-term sentiment is out of favor. So you try to buy the market or the index or the stock or whatever you're pulling up on the market forecast indicator on days like that if you are hoping that the trend continues to the upside, and this is a momentary time to buy it while it's cheaper as opposed to buying it when the price is a lot higher, right? So, and this was actually a legitimate pullback here. Sometimes we see these bullish intermediate confirmation signals, and I kind of scratch my head thinking, that's hardly anything. Like it's like a 0.5% give back, right? That doesn't really feel like buying the dip to me. This is a little bit more aggressive, right? Even today was more than 1% here, but then you include yesterday's sell-off in addition to that, and that's a pretty decent 2-day pullback there. So we'll see if we can reestablish a support bounce opportunity here around this rising 30-day moving average. And you had kind of your first test of that here today on the Dow Jones Industrial Average. So anyway, not a whole lot changed despite the heavy selling from a breadth perspective today, with over 80% of the stocks in the market closing lower. We still have strongly bullish postures across all four of these charts, and we are still trading above rising 30-day moving averages on all four of the charts as well. But it is, again, the Russell 2000 that stands the greatest chance to see that change as soon as tomorrow. So let's keep our eye on how the market reacts to the jobs number. All right, let's go ahead and now take a look here at our 3 green arrows chart. This is chart 4D for those of you that are following along at home. And at this moment, we actually don't have any 3 green arrows signals or any 3 red arrow signals. All 4 of these charts have a mix of green and red arrows. Prior to today, we did have some 3 green arrows charts. In fact, we had that on 3 out of the 4 charts. But with today's selling, we did see some red arrows starting to creep in, including on the S&P 500. So right now we continue to have 2 green arrows. So there's one on the moving average, there's another one on the stochastic, but the most recent arrow on the MACD histogram, as you can see today, is now red. So That's why the background color is now white as opposed to where it was yesterday in green. Same thing on the Dow Jones. You still have your green arrow on the moving average and on the stochastic, but you now have a red arrow on the MACD histogram. So it's basically telling us we have a loss of momentum. That's what that MACD histogram is telling us. Down below here on the Russell 2000, somewhat similar. Yesterday you had a 3 green arrow signal, but today you no longer do. However, this one's a little bit different than the other two I mentioned because not only do you have the red arrow coming in on the Russell 2000 on the MACD histogram, but you also got a red arrow here on the stochastic. The other two still have green arrows on the stochastic. So this one is starting to be a little bit more concerning. Remember, the stochastic is trying to measure where a stock, or in this case an index, is closing or trading within a recent range. And if it's closing or trading at the low ends of the range, you're going to have a greater opportunity for the stochastics to start plotting those red arrows there. The NASDAQ's a little different than the other three. You have a red arrow on the MACD histogram as well, similar to the S&P 500 and the Dow Jones, but what makes it different is that this red arrow actually came in back on June 21st, which was a couple of weeks ago at this point. So it wasn't like a recent phenomenon there. So it's continued to retain that red arrow there, whereas it does still have the green arrow on the stochastic and the green arrow on the moving average. So today is somewhat of a rare day where none of these 4 charts have either 3 green arrows or 3 red arrow signals. Let's now take a further look back at a 1040 crossover chart. This is chart 4C for those of you following along at home. And we kind of have the same view on this particular chart setup as we've had in recent weeks. In other words, we have 3 out of these 4 charts with what we'd refer to as a golden cross, and 1 out of the 4 as a death cross. For those of you that are Indiana Jones fans, maybe you saw the movie here recently. For some reason, whenever I think about Death Cross, I think Indiana Jones. That would be a good term for that type of a movie. Maybe The Last Crusade, you could have that. But in the context of the financial markets, the Death Cross is basically looking at 2 different moving averages, and what we use here is a 10-week moving average represented by the orange line, and a 40-week moving average represented by the blue line. And when the more recent moving average, or the more sensitive one, is below the less sensitive one, that's what is referred to as a death cross. And that's what we have right now on the Russell 2000. So it's a way of saying that the Russell 2000 has been lagging the other charts on a relative basis. We have golden crosses still in place, where the opposite occurs, where the orange line is above the blue line on the S&P 500, which occurred back in April and continues to be the case, on the Dow Jones, which happened also back in April and continues to be the case, and then on the NASDAQ, it occurred also at the beginning of April and continues to be the case. So the only oddball out, or the odd man out there, is the Russell 2000. Strangely, it actually had a brief period of time with a golden cross here earlier this year in January and February, but it has not had it more recently like the others. And a lot of that is as a result of how the Russell 2000 kind of reacted to the banking crisis. Remember, over 10% of the Russell 2000 is banks, especially kind of mid and smaller banks that were at the heart of the the banking crisis and the bank run controversy and all that kind of stuff with Silicon Valley Bank here back in March. So I think that's the reason why you're seeing it lag compared to the others. All right, let's go ahead and now pop on over here to the internet. I always appreciate you guys helping us along with our request to get the word out to our audience as best as we can. So the last time I did the video, you guys stepped up to the plate for me, and 113 of you clicked like. And as I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full-length video the next time I do the video. And so let's do some shout-outs there to some of our most loyal supporters. Thank you to Irene and to Ryan and to Investing Quotes and to John and Roy and Vince, Carlisle, Iakipa, Greg, Phil, Scott, Surendar, Brandon, Tom, ELS, Doug, Michael, Lucius, John, DGI and Options Daily, Roger, Member, Roger, Ash, Teddy, Maria, Leah, Dave, Paul, Pam, Jayesh, HR, Teresa, Paul, the list goes on and on and on. Lots of great supporters there. I can't get to all of you, but every so often, hopefully you hear me rattle off your name just to acknowledge you and to say thank you, because I know it does take you an extra, 5 seconds or whatever it does to do it. So it's better than all the people who just refuse to do anything. So it's my small way of saying thank you to you. So please keep that up. And again, I'll make the same offer for you next time I do the video, which will be, I guess, Tuesday. If we're up and over 100 likes by the time I'm scheduled to do it, I'll be more than happy to give you a full-length video like the one that we're currently a part of, including all the 12 grid analysis and the sector selectors and all the trade application examples and all that kind of good stuff. The last couple of times I've done a trade on Thursday, of course last week I was gone, so I got a chance to travel to the great state of South Carolina, enjoyed my time there. But anyway, last 2 Thursdays prior to that, I did a bearish trade, and both of them went to max gain the very next day. I think one of them was on Disney and the other one was on Starbucks. I'm going to be doing another bearish trade here in tonight's video. So if we go to max gain on that tomorrow, I will wonder if maybe I should take a trip to Vegas or something like that. I highly doubt it's going to happen because I think this one's going to be a little bit more of a stretch. Nonetheless, it has been nice to see some of those trades working out for us more recently. All right, let's also quickly let you know here again, I mentioned this before, but you can kind of see this more visually now. This is the new Threads social media platform. I think it's designed more for mobile, so it looks a little bit less appealing here, I think, on the desktop. Nonetheless, if you are looking for us on Threads, you should be able to find us looking at our logo there or just looking up in the search bar Market Scholars. And again, we're probably not going to be posting a ton here, but we'll post a few things like our dividend growth investing increases and some of that type of stuff on there for those of you that want to check out that new social media platform. We would invite you to join us by clicking the follow button on us over there as well. Speaking of the dividend post that I just posted there on Threads, remember that at the end of each month or the beginning of the new month, I have a couple of posts that I post to our website, and this is completely free. So even if you're not a premium or plus member of Market Scholars, you can access this part of our website. You don't get access to our classes, but you can get access to a handful of things for free if it is of interest to you. And in order to find those posts, you'd come to marketscholars.com and then hover your mouse over blog and then click on dividend growth investing category here. And I do have a post here more recently about the sector attractiveness for dividend growth investors who are looking to put new money to work for the long term and which areas of the market seem a little bit more interesting than others. And then I have another post here showing you which stocks increased their dividends last month. So, stocks like Casey's, the good old gas station chain there in the Midwest, and Caterpillar and Kroger and Realty Income and Target and United Healthcare, they all reported increases in dividends last month. So if you want to check that out, feel free to check that out on our website there as well. And then last but not least, let's have a quick little review of our sector selector here. Not a lot changed week over week, but one thing I did want to point out, since I was not with you last week as I was out of town, information technology is no longer at the top. Remember, they had a good run at the top of 5 weeks in a row, if you kind of backtrack that bright green circles that you see right there. So information technology was number one from May 19th until basically June 23rd. And then information technology went down and was replaced by consumer discretionary. And for the second straight week, those rankings held. So that was somewhat interesting. And I've seen a few tweets about that here and there, but I don't know if it's really something that is catching hold with a lot of people yet. There's kind of this general assumption that technology is still ruling the roost, and they're certainly doing fine, right? Again, today we saw Microsoft and Apple up, but they're not necessarily beating the rest of the market on a relative basis as much as they were about a month ago. So it seems like a little bit of that kind of enthusiasm around artificial intelligence has kind of cooled off. It hasn't necessarily gone ice cold. It's just cooled off from its ultra hot temperatures that it had a month or so ago. So right now, you've got consumer discretionary back there at the top, with stocks like Tesla and Amazon doing particularly well here more recently. And industrials probably don't get a lot of love either. We've been concentrating a lot of our efforts in my top-down trend trading class on the industrials, but it seems like they kind of get lost in the noise. Everybody likes to talk about discretionary technology and communications, but industrials have been sneaky strong for quite some time. They have been listed in the top 4 of these rankings going all the way back here to the end of April. The end of April, they were 5th, then they clicked into number 3, and they've stayed top 4 the entire time there. So we're talking, 2.5 months that industrials have been outperformers there as well. And then at the bottom of the sector selector, you'll see that we have more of our defensive areas like utilities and consumer staples, suck and win, so to speak. And that's probably a good thing, all else being equal, right? Not anything against those particular sectors, because I certainly have my fair share of them personally as a dividend investor. But in general, if you're trying to judge the health of the overall market, you want to see a market that's led higher by growth and cyclicals, and you want to see the defensive areas lagging. And that is kind of what we have seen and witnessed here more recently. So all in all, a pretty good breakdown of the sector selector. But of course, things change, and when they do, we'll discover them here in these videos, assuming you guys are clicking like, and we're getting up over 100 likes. But regardless, if you're a premium member, we'll always talk about this in our Monday classes as well. All right, let's go ahead and get back over here to the main part of the Thinkorswim platform, and let's do some 12 grid analysis. Starting with chart 5A, this is our asset class 12 grid. And a reminder that the background colors of these miniature 12 grid charts are going to show us what the current posture is. It's not going to kind of flip-flop between postures like our bigger 4 grid charts do. So anyway, when we look at this, I usually like to start our conversation in the lower corners, as I think that tends to kind of drive activity amongst the rest of the market. So let's start today in the lower right-hand corner and talk about TNX, which is the ticker symbol you can use on the Thinkorswim platform to look up the 10-year U.S. Treasury yield. And my, oh my, it's been a strong, week for TNX, with 4 out of the last 5 days to the upside, and not just gentle moves, pretty aggressive moves to the upside as well. So all of a sudden, the 10-year is above 4% again. Remember, on the Thinkorswim platform, you move that decimal point over to the left 1 in order to see what the actual true yield is. So if I were to right click, and so you can see this a little bit better, we can go back and kind of get a sense, when was the last time we had a 4% yield on the 10-year? It's been a while. Let's go back on a 6-month chart, and you can see the last time we had it was basically for a day, and that was right here on March 2nd. But other than March 2nd, there has been no other day where Treasury yields have been higher than where we find them right now. And even if you go back a year, you're going to see most of the last year Treasury yields, at least the 10-year, are less than what we are at right now. You basically had that one day in March that I mentioned before, and then you had kind of this topping pattern back here in October and November. Otherwise, this is the highest that the 10-year has been, right? We've talked about the inverted yield curve and that sort of thing over the last couple of years. So we know some of the other shorter term, maturities in particular have been much higher than this. And in fact, some of them have been over 5%. But specifically for the 10-year, this is actually a very high amount. So again, going back to what I had kind of briefly mentioned in the heat map earlier, how all of the utilities were down today, and that was a very interest rate sensitive group. Now we can see why they responded the way that they did. The 10-year has been on an aggressive move here in the last week, right? Before this, 4 out of 5 day upswing that we had here, it was kind of giving us the impression where we didn't really know what to make of it. We wanted to kind of give it the benefit of the doubt because it was above a rising moving average for the month prior to that, but it kind of gave us a sense that it was kind of straining to make a further advance. Well, that has definitely changed in the last week and a half. That has been a really solid move higher. And remember, that's not necessarily a good thing for the rest of the market. Generally speaking, we don't like it when interest rates are rising because it starts to cut into profitability for a lot of corporations, right? The higher their interest expenses are on their corporate debt, the less money is left over for shareholders in the form of dividends and other things like that. So anyway, we'll keep our eye on that situation, but right now, that looks like a strong trend right there, but it's not a good sign for the market in general, all else being equal. Naturally, when interest rates go up, bond prices themselves go down. And today was a doozy in terms of bond price movement. TLT was down 1.41%, and you can see TLT is now at 3-month lows. Now remember, we are now out of our iron condor on TLT, so I am thankful for that because I'd start to get worried about this once again here. We had that thing expire at max gain somewhere over here, kind of in the middle of June, and we were just fine on that trade. But for those of you that started to also sell iron condors in the month of July, keep your eye on that, right? You might need to babysit your position a little bit more now that we see a break through that previous support area right there. Let me right-click on this as well, because I'm curious if we go back on a 6-month chart. It's kind of the same situation, just the opposite, kind of like a Rorschach test. You can see over here it was March 2nd is the only day on the chart of TLT where it was lower. Remember on TNX, March 2nd was the only day where interest rates were higher. So it makes sense that March 2nd was the only day that bond prices were lower. So this is a pretty, aggressive 3-day sell-off that we see here in TLT, and it has broken that support level there from the end of May, and now you're starting to call into question whether you're going to go to half-a-year lows here all of a sudden on TLT. So again, be careful with that one. That one is one that you'll definitely want to babysit if you're doing iron condors or other defined risk types of trades like that on there. In addition to TLT, and by the way, TLT is now to a strongly bearish posture. As you can see, the background color of that chart is that darker shade of pink. Whereas with the other two bond categories that we have in front of us, foreign bonds and high yield bonds, they have that lighter pink shading. So that means they have weakly bearish postures, but long-term U.S. Treasuries have strongly bearish postures. Nonetheless, it was a pretty aggressive sell-off day for these other two bond categories as well, at least judging by what you see on the chart. When you look at the end result of 0.51% to the downside, that's not really particularly aggressive, but what I'm kind of referencing is notice the big gap that you have right here on foreign bonds, and notice the big gap that you have right here on high yield bonds. Those are pretty aggressive days. You don't really get the true sense of it through the end result. Nonetheless, it's something that you definitely want to pay attention to, right? This was an important day in the bond market. Notice that high yield bonds were down here and nearly broke to 3-month lows, and foreign bonds did. It's just that foreign bonds rallied enough at the end of the day where they didn't quite close as low as where they closed on this day back here on May 25th when they put in that oversold cluster signal. With high yield bonds, you did not quite breach on an intraday basis that level in late May, but that could be in the cards, going forward. We shall see. So all three of those charts now have red 30-day moving averages as well, telling us that price is below falling 30-day moving averages. In terms of the US dollar now, in the lower left-hand corner, notice that like the 10-year Treasury yield, it continues to have a strongly bullish posture. The US dollar today was actually down a touch, which is a little bit surprising. Sometimes you get these heavier sell-off days in the stock market, and it may be a direct result of the US dollar strengthening, but today was not one of those days. Nonetheless, you had a very nice day yesterday in the US dollar, so perhaps today was just a little bit of a give back of that. You can see that it remains above a rising 30-day moving average and retains that strongly bullish posture. It didn't really have any sort of a major impact on the other indices out there. Sometimes the dollar can kind of play a strong role in how commodities and foreign stocks react, but I wouldn't really categorize today as one of those types of days. Notice that the gold market was actually down today, not up, and not by a whole lot, but still it was in the red today by 0.3%. Oil was also down 0.3%. And then if you look up above here, notice that foreign stocks actually underperformed US stocks. EFA was down 1.73%, and EEM was down 2.04%. Both of those look pretty ugly here all of a sudden. Now remember, EFA has already been underperforming, so that one is a little bit less surprising. Remember, that's where you're going to find Europe, Japan, Australia, that sort of thing. And of course, we've all been watching from afar what's been happening in France. And if those videos are to be believed that we're seeing on Facebook and Twitter and elsewhere, we our hearts are with you. That looks like a very chaotic situation that y'all are dealing with over there. And so, of course, we are hoping that you are staying safe and your families are as well. But, it makes you wonder if some of that instability in Europe is starting to find its way into the stock markets over there as well. Because when you look at the chart of EFA and then compare it to the USA over here, those are two different trajectories right there. EFA clearly going lower with a strongly bearish posture, USA clearly going higher with a strongly bullish posture. Of course, things do change. Markets are always cyclical, but that's where the trends are at the moment. EEM, of course, is also foreign, but this is the emerging markets. So think China, Russia, Brazil, India, Mexico, Turkey, Indonesia, those types of places. They had been performing a little bit better than the developed foreign world, but even that is starting to be called into question. This was a pretty aggressive breakdown below the 30-day moving average today. In fact, it's a rare time where the moving average goes from green to red. Remember, there's usually a transition of yellow in between there. But sometimes when you have a really sharp day, either down or up, you can have the flip to either bullish to bearish or bearish to bullish in a heartbeat. And that's kind of what happened here. You were trading above a rising moving average. This was a pretty aggressive 2% sell-off in the emerging markets today. That actually bent the moving average lower on one single day right there. So a very important day for EEM as well. Again, looking at the trends, I don't think EEM looks quite as bad as EFA. EEM might actually be primed for an iron condor type of a situation here, as we're kind of trading in the middle of the range, whereas EFA actually touched a 3-month low today. So not looking very healthy there at all. Preferred stocks were down about 1.5% today. They're back to a weekly bearish posture. And then Bitcoin kind of held its own. Bitcoin has firmed up very nicely over the past couple of weeks. And it was somewhat impressive that they retained a decent amount of their strength today. Obviously, they were down, but it could have been a lot worse. A lot of times, Bitcoin kind of is a hypercharged version of the NASDAQ. Today, it kind of it had a little bit more resolve there. So anyway, I saw a post that Giselle and Tom Brady lost a boatload of money in that whole FTX scandal that took place last year. I think it was like something between $40 and $50 million. So even for an awfully rich couple like those two, that's got to leave a mark. So anytime you think you're having a bad day, just remember there are people losing a lot more money than you out there. And maybe they don't notice it, right, because they're so rich anyway. But that certainly caught my eye today when you're talking about those types of numbers. There's a lot of speculative fervor, or at least there was in the cryptocurrency universe, and some of that is getting washed away right now. But Bitcoin itself has actually been reasonably strong here more recently. All right, let's go ahead. And by the way, Bitcoin does retain its strongly bullish posture, as you can see from the green background color of the chart. Let's go ahead and take a look at our sectors now. This will be chart 5C for those of you that are following along at home. And, I guess it's not entirely surprising given what we know about our foregrid that we looked at from kind of the main indices perspective, and how all four of them still had their strongly bullish postures. I guess if you take that down to the sector level, it shouldn't be a surprise that most of the sectors are still retaining their bullish postures. But there are two at the moment that have bearish postures, and that is energy and that is healthcare. Energy was down 2.25% today, so it was the worst performer on a percentage basis here today. Healthcare was down only 0.8%, so not nearly as bad. Nonetheless, both of them are now in that kind of light pink background color, telling us that we have weakly bearish postures. Not strongly bearish, but weakly bearish. All the other sectors still have the green background colors. Now, utilities, you can see, is that lighter color of green, so it's a weakly bullish posture, not strongly bullish. And again, it was down fairly substantially today, down 1.21%, but it is still kind of hanging out right at its moving average, so there's still some hope there. We shall see. One of the positive elements of utilities, if you want to think of it that way, is it has vastly underperformed the rest of the market in the last 3 months. So today would have been a day where utilities would have likely gotten hit no matter what because interest rates were surging. But because they really haven't gone up tremendously, they probably have less to give back as well. So I think utilities are kind of an interesting place for long-term money to be seeking out at the moment. There are some interesting opportunities out there that we talk about in our DGI classes. So anyway, we'll keep our eyes on that possibility. But yeah, it was a bad day for utilities, but at least they kind of held the line there at the 30-day moving average. You'll notice that real estate actually is trading, believe it or not, closer to their 3-month highs than 3-month lows. That's also impressive for an interest rate sensitive group. And then consumer staples is at least above its moving average. Remember, for the longest time, consumer staples was in the house of pain, below their moving average. And boy, oh boy, have I felt that, as I have a lot of consumer staples in my own long-term portfolio as a dividend investor. So I have definitely been recognizing that underperformance myself. But here more recently, there's been a little bit more of an oomph. I don't know if they're going to have what it takes to actually go on a big move or not, but at least you're stopping the bleeding at a minimum. We'll take what we can get at this point. With the more traditional growth areas, their trends are still largely intact. You know, the upper grouping up here with technology, communications, and discretionary, those are still some pretty strong uptrends. Now, technology, this will kind of show you again kind of what I was referencing on the sector selector. Notice that technology did not usurp its prior high. Its prior high was in the middle of June, and in the run that ended here about 3 days ago at the end of June, we were not above that prior high. With communications, we were. Remember, Meta is going to be a big player in communications. And then with discretionary, we were as well. So, you know, Tesla has had a nice run here recently as just one example. So this is another way to kind of visualize what we had talked about previously that I don't think a lot of people are talking about right now. There's just a little bit of sheen coming off of the tech trade here recently. We don't want to make too much of it because obviously it's still above its rising moving average. But, you know, we try to point out those little things on the chart, those little signs that could be telling us a bit of a story that maybe is not being told by the mainstream media quite yet. So we'll keep our eye on it, but this is the third straight day to the downside with technology, and they have yet to achieve a higher high from mid-June, whereas those other two growth areas have been able to accomplish that. In kind of the middle rung here, you do see that today was a pretty healthy give back for some of the more cyclical areas. Financials were down 0.86% today. Industrials were down 0.75% today. And materials have really gotten roughed up here in the last 2 days in particular. Yesterday was a terrible day for materials, and then they followed up with another day of selling today. And remember, just last week, materials had that overbought cluster signal. I'm pretty sure they were the only sector that did. Yeah, as I glance at all the others, none of the others had this red dot above their candles last week, but materials did. So it gave us a sense that materials probably got a little bit too giddy for their own good with upside potential. They put in that overbought cluster signal. And remember, for those of you that are premium members, when you're looking at this chart 5C, you can right click and then go to maximize right here. So that way you can see the actual market forecast indicator down below to confirm it with your own eyes. But notice how on this day on June 30th, materials had the red, the green, and the blue lines all in the upper reversal zone, kind of in that pink area above the 80th percentile on the same day. When that happens, one of those little red dots appears up there to give us a sense that, hey, this is probably a time to start pulling off some of your bullish trades in that particular entity. Or if you're really aggressive, maybe start putting on some bearish ones. Of course, you got to be careful with that because they don't always work out the way that you want, but this is a pretty good case study of where it worked out the way that it's kind of designed to, right? You have your two oversold cluster signals here with these green dots. So that's a time where you start, shutting down your bearish trades, and if you're aggressive, starting to put on bullish ones. And it took about a week, but eventually when it got going in a big way, right? You had a pretty big move here on the materials sector from the end of May until basically here at the end of June. So that was basically month end to month end. That was a very aggressive move where you ended the previous month with oversold cluster signals, and then you ended this most recent one with an overbought cluster signal, and so now you've kind of given back a pretty big chunk of that. You know, you'll notice here that in the last 2 days, we've basically given back an entire month's worth of trading on the materials. So that's why sometimes it can be frustrating when you take action on those little red dots there because they don't always work out. But sometimes when they work out, they really work out. This is a case where, yeah, you could have gotten slightly better prices the next day, but you know, you're really kind of nitpicking when you're saying something like that. Because had you been too cute for your own good and said, well, I'm going to wait for further evidence, well, you would have missed a big chunk of the move in just 2 days, right? You gave back basically a month's worth of gains in 2 days, but it could have been prevented had you taken some action when you saw those little red dots appear. Again, I got to be careful there because they're not always going to work that way, but at least, hey, there's a good example of where it worked out the way that we'd like it to work out in that case. So anyway, we did have heavy selling today. Every single one of these sectors was down today, and it was led down by the energy area, down over 2%. In terms of the area that held up the best, that was consumer staples. It was only down 0.25% today. I did notice that Keurig Dr. Pepper was one of the stocks that was leading the market today. And of course, they're part of the consumer staples area. But oftentimes when we get heavy selling, the defensive areas hold up better. And so they kind of fulfilled upon their role there today. All right, let's go ahead and now talk about our trade application example. And a reminder that I do these trade application examples while the stock market is still open, and then I do send out the trade details and the screenshots and all that kind of stuff via our private Telegram channel to our premium members of Market Scholars. And today you had a full 15 minutes to consider whether you wanted to take the trade or not. Sometimes, you know, I'm rushing it towards the end of the bell there, but today I gave you a little bit of extra time to think it through if you wanted to. So let's talk it through collectively here now on the video. And I'm just going to pull up chart 3A for this conversation, our swing trading chart. And I'm going to pull up a fairly well-known technology company. It's actually in the Dow Jones Industrial Average, which a lot of people find to be somewhat funny, considering there are bigger companies like Amazon that are not in the Dow Jones. Nonetheless, Salesforce.com, ticker symbol CRM, is a Dow Jones member, and I chose it today as a bearish trade example. I did not do it as an options trade. It was just a straight selling short of the stock, similar to what I did a couple of weeks ago with Disney, and then the next week after that with Starbucks. So, you know, you can obviously trade bearish options on it if you wanted to, but I didn't find that the percentages I was receiving when I kind of tested them out were attractive enough for what I was hoping to accomplish. But one of the nice things about Salesforce.com is that they are kind of off cycle in terms of when they report their earnings. And many of you know that now that we're into the month of July, we're going to start hearing from the banks, I think, as soon as next week. They'll kick off earnings season, and we're going to have hundreds and hundreds of companies that are going to report before the August expiration. So this is one where if you're hoping to avoid trading through earnings expirations, then Salesforce.com could be an interesting one to target for the August monthly contracts. Nonetheless, what I ended up doing today was just merely playing with the stock itself. And what I did was short sold it. And the reason behind that decision, let me go through them. First of all, you'll notice that today the background color of the chart went from green, I'm sorry, not green, but blue yesterday to pink today. I'm so used to our other charts where we have green backgrounds. This is actually blue to help us, help remind us that this particular chart is taking its clues from the blue line on the market forecast, not the green line. And we use this chart when we are trying to be in a trade for a shorter amount of time. Remember, the green line is an intermediate time period, so think months. The blue line is a shorter term period, a near term period that you can think in terms of only being in the trade for weeks. So we usually use this for our swing trading class as an example. So we had a posture shift, and that happened because the blue line stopped going up and started going down. Now, in addition to that, you can see that the moving average color also changed. Notice that yesterday the moving average color was green. Today it is red. So what that identifies is price of this security is now below a falling 30-day moving average. Now, in addition to that, you'll see down below that the green line itself is falling, so you would also have a bearish posture using the intermediate setting system in addition to this near-term posture setting system. And in addition to that, you have what's known as a bearish near-term divergence that is setting up on this trade as well. Notice down below you have this peak in the blue line right here on June 29th. You have a follow-up peak on the blue line here on July 5th, just yesterday. Notice that the one yesterday is much lower than the first one. So you had lower highs on the indicator itself, yet on the stock prices or candles up above, it would be associated with this candle right here and this candle right here. So obviously price went up at a time when there was deterioration on the underlying indicator. Sometimes that gives us a heads up that there is more than meets the eye of price and that there is a little bit more to be concerned with price-wise. At least that's the interpretation of the indicator down below. Now, one thing that is a little bit dicier about this, remember, none of these trades will ever be perfect. There's always going to be flies in the ointment. One of the things to be aware of is this is currently a market-beating security. Notice the S&P 500 has its dotted line slightly below the price candle of Salesforce.com today, and you can see that these labels up at the top of the chart are green across the board, telling us that we have positive performance on all of these. Just barely on the 1 month, by the way. It's only up 0.13%, but some of these are much healthier numbers, like 6 months is up 55%. So sometimes it can be a little dangerous trying to short sell a stock that has done as well as Salesforce.com has, but if you're ever going to do it, I think today is kind of one of those days where it makes a little bit more sense, where it crossed below the moving average, you had a shift in the posture, and you also have that near-term bearish divergence signal that I've mentioned before. So we'll see how that goes. If you're looking for the levels, again, I've got that listed in our private Telegram channel for our premium members. Otherwise, you can kind of see them listed here as well. We're going to be shooting for a price target somewhere down here close to $202, whereas our upside stop loss will be up here closer to about $218. Okay, so that's what I had for you here today. I appreciate you checking out this video. If you want me to do another full-length video for you on Tuesday, then I would encourage you to click like for me there on Twitter. As long as we're up and over 100 likes, I'll be happy to do that for you. On the other hand, if you think that these videos are getting a little bit too lengthy for your own desires, then don't click like. And if they're under 100 likes, I'll just plan on keeping it short and sweet for you at 15 minutes worth of length there for you. So I'll let you guys decide there collectively, but whatever it is that you decide, I appreciate you checking out tonight's video. I hope you all have a fantastic weekend as well. Best of success with your trades and your investments. Goodbye for now.